We've all heard the term QE, or quantitative easing. It's when the Federal Reserve prints billions of dollars to stimulate the economy. Well, what do you call it when the Fed outsources the money printing to the banks? I call it stealth QE, and it's happening right now as a matter of federal policy, effective today, and almost nobody outside of the banking world has ever even heard of it. I'm Stan Brzezowski. I've been in the mortgage business since 1999. Today, I want to show you something that's hiding in plain sight. It's a rule change that lets banks create new money the same way the Fed does, without the Fed ever having to get its hands dirty. By the end of this video, you're going to understand exactly how it works, why they're doing it on purpose, and why it matters to you as someone trying to buy a home, maybe more than anything else in the economy right now. We're going to get into some technical stuff here. Capital ratios, leverage rules, things that sound like they probably belong in an economics textbook, not in a video about buying a home. But I think you're owed an actual explanation of what's going on here, not some dumbed down version of it. Stick with me, we're going to put this into plain language. Okay, so when it comes to money creation, most people think that's the job of the Federal Reserve to do that exclusively. The Fed prints dollars, the Fed buys bonds, the Fed expands its balance sheet, and that's pretty much how it works, right? Everything else is just banks moving around money that already exists. But that's not entirely true. In fact, it's never been entirely true. And what's happening right now is actually one of the best examples of what I'm talking about that you're going to find. You see, banks also create money. Every time a bank makes a loan, it's not handing you money that was sitting in a vault somewhere. It's creating a new deposit out of thin air the moment the loan gets funded. Listen, I'm not trying to be controversial here. This is literally how a fractional reserve banking system works, and it's been true in this country for over a century. So what is it that limits how much money a bank can actually create this way? Well, that's something called capital rules. Specifically, in this case, something called the Supplementary Leverage Ratio, or SLR. Now, here's how it works. A bank has to hold a certain amount of its own capital, its own skin in the game, for every dollar of assets it has on its books. It's called reserves. Okay, so loans, treasury bonds, you name it, the bank has to have some capital to back that up. So surprisingly, the original version of this rule didn't care whether those assets were risky or safe assets. So, for instance, a loan to a struggling small business, which would be pretty risky, and a loan to the U.S. government in the form of a treasury bond, which is about as risk-free as you're going to get, well, they're both counted exactly the same way against that ratio. So that means that a bank's capacity to hold safe assets, like government bonds, gets squeezed by the same rule that's meant to stop them from loading up on risky ones. So here's what happens when you loosen that ratio. The bank's own capital doesn't change. Nothing new comes in the door. But the amount of lending and bond buying that same capital can support, well, it goes up. It goes up a lot. It's that simple. That's it. That's how it works. You don't need the Fed to print a single dollar to stimulate the economy. You just need to let the banks hold more assets on their books, and the new money just sort of shows up anyway. It shows up quietly as loans and as bond purchases instead of as press releases from the Federal Reserve. Now listen, this isn't theoretical. It's already happened once before, recently, actually, back in April of 2020, when the Federal Reserve temporarily suspended the SLR rule to lower rates and stimulate the economy during COVID. Well, banks loaded up on government bonds, lending exploded. We all saw what happened to interest rates. So when the rule suspension expired a year later, well, some of the biggest banks that benefited from the rule suspension, well, they went straight to the Fed and they asked them to make it permanent. Well, it's been 5 years, but here we are, late 2025. The federal regulators, the Fed, the OCC, and the FDIC, well, they finalized a new rule that does almost exactly the same thing that happened in 2020. It's already in effect. Banks have been allowed to use it since January of this year, and it became fully effective for everybody covered by it on April 1st of 2026. We're not talking about small numbers here. By the FDIC's own estimate, this single rule change cuts Tier 1 capital requirements for major banks by around 28%. That may not mean much to you, but it frees up an enormous amount of capacity for banks to hold more government debt and make more loans, all without the Fed having to put its fingerprints on it. One of the regulators who voted to approve it said, in his own words, that it helps undo the negative consequences of discretionary policy decisions made after the 2008 financial crisis. In other words, the rules put in place to prevent the next 2008 are now being described as the problem. Okay, so that's a big change and it's already done and in place. But if that wasn't enough, it's not the only lever being pulled right now. There's a second one. Now, unlike the SLR rule, this one isn't finished yet. It's still being talked about as I'm recording this video. It's a separate proposal, part of something called the Basel III Endgame Framework. And it deals with how much capital the banks have to hold specifically against the mortgages that they service. Right now, the banks pay a capital penalty for holding and servicing mortgages past a certain amount. The new proposal reduces the burden of that penalty. Some regulators are saying, again in their own words, that the goal is to keep mortgage origination and servicing inside the regulated banking system rather than letting it keep migrating out to independent mortgage companies that aren't under the same rules. This one's a proposal. It's not a final rule. The public comment period on it closes this week. I don't know exactly what the final version is going to look like. But the point is, it's the same playbook as the SLR rule aimed at the same target, freeing up bank capital on purpose by regulatory design so more lending can happen without anyone having to call it quantitative easing. So we've seen this movie before. In 2020, when the SLR rule was suspended the first time, well, the banks gorged themselves on treasuries, rates plummeted, lending exploded, and home prices did exactly what you'd expect when there's suddenly a lot more money chasing the same number of houses. Home prices went up. They went up really fast. Now, we're not in a once-in-a-century pandemic right now, but we've got the same lever being pulled again, this time permanently, plus a second one right behind it. It's not a coincidence that both of these are happening at the same time, pushed by the same officials in the same direction. So what does it all mean for you? Well, it's one thing when the home that you already own doubles in value. Like, that's a good thing, right? It's an entirely different thing when the home you want to own doubles in value. So if you're looking to buy and you feel like you're chasing rising prices now, well, this is just going to keep pushing the finish line further and further away for you. Now, we've talked a lot on this channel about monetary policy and inflation and what that historically has done to asset values, specifically home values. Truth is, none of this is something you or I have any control over. The mechanism for putting more dollars into the system is in place. It's already in motion. Whether you buy a home next year or wait another 5 years, the only thing you control is which side of the ledger you're on when it plays out. The side that owns a home or the side watching home prices continue to rise out of sight. Buying a home isn't right for everybody. I totally get it. There's times in your life where renting makes perfect sense. But if you're someone for whom owning a home actually does make sense, waiting for tomorrow or for next year is just really costing you financially. That's where I come in. If you want to sit down and find out whether buying a home now actually makes sense for your specific situation, there's a link in the description to book a time on my calendar. No obligation, just a conversation. For that matter, if you're not ready to talk, that's cool too. There's also a link where you can get a copy of my book, You Can Do This, the No BS Guide to Financing Your First Home. You can download it for free, and it covers the process of buying your first home from start to finish. Bottom line, the money printer doesn't have to say Federal Reserve on it to do its job. I'm Stan Brzezowski. Let's talk.